So we will calculate weighted average cost of capital. We represent that as K subscript O, weighted average cost of capital. The following information has been extracted from the balance sheet of ABC Limited as on 31st March. While calculating the KO, we can calculate using the market value approach. Another one is book value approach. Okay. Let me first try to solve the illustration using the market value approach. So book value approach, and then we'll go with the market value. The value given in the book will be as it is will be taken, which is called book value approach. Then market value for the equity share capital will be taken for the capital structure calculations. Then it is called market value approach. Determine the KO. It had been paying the dividends, so you have to calculate this one. It had been paying dividends at a consistent rate of 20% per annum. 20% per annum. Is that clear? Right. So now we have to calculate the cost. In case of equity share, it will be cost of equity capital. In case of debentures, cost of debt. In case of term loan, cost of term loan. Okay. Clear? Cost of debt, cost of term loan. The cost for the debentures, the tax applicable tax rate being 40%. So KD in this case is equal to interest by net profits. So nothing stated, we assume the value remains same. Face value will be the realizable value or net profits. For every 100 rupees, 12 rupees will be the interest payment. 12 by 100. This is before tax. In case of tax, just to multiply with the tax into 1 minus t. Into 1 minus t. Okay. Then 12 by 100 into 1 minus 0.4. 7.2%. Is that clear? Okay. In case KD before tax, this is KD after tax. KD before tax, 12 by 100 only, right? Interest by net profits. Then the value being only 12%. Similarly, in case of term loan, KT before tax, interest rate divided by loan amount. Okay, interest rate, simply interest rate. Usually in case of KT, cost of term loan remains the same, 18%. KT after tax, what the KT you calculate before tax, you know. With that, you just multiply with the 1 minus t. 18% into 1 minus t being 0.4. Then the ultimate value be 10.80. In case of KE, KE before tax and after tax will be the same. So a consistent dividend rate is given 20%. Constant dividend approach, constant growth approach, constant dividend approach, earnings approach, earnings growth approach. So we have a number of methods, around 4 or 5 methods we have. If only dividend is given, you can straight away take that one. 20 divided by dividend per share divided by book value of the share. Dividend being 20, book value of the share being 100 from the next information. 20%. Clear? Cost before tax. Cost before tax. So we'll now calculate cost before tax. Cost cost of equity will be after tax as well as before tax. You'll get the same value, right? Before tax and after tax, you'll get the same value. Before tax and after tax. Cost of equity capital being 20%. Cost of debt before tax being 12%. Cost of term loan before tax being 18%. What about the overall value you are going to pay? Overall cost in terms of rupees. For 400, 20% should be payable, which is 80. In case of debentures, 12% and 400, 48. 1200 into 18%, 216. Then overall cost you're supposed to pay here being 344. What about the KO under this? Cost by capital employed. Capital employed as per the book value approach being 2000. 344 divided by 2000 in terms of percentage. 17.2%. Okay. What difference will it make if the current price of rupees 100 share traded in the market at 160? If the market price is 160, then KE in this case being as per the market value approach. Dividend per share payable divided by market value, investors' view. Dividend remains the same 20. The company always pays the 20 rupees dividend per 100 rupees of the face value. They never bother about what about the market value. When the company announces the dividend percentage, always the dividend percentage will be applicable on the face value. Face value is nothing but the book value excluding the reserves and surplus. And for the investors, of course, for 10 rupees share, he may pay around 50 or 70 rupees, doesn't matter. Whatever the rate may be. The dividend, what declared by the company remains the same. So that's the problem. So the numerator will be the same 20, but 100 rupees share is traded 160. As an investor, how much you have to invest? 160 rupees you have to invest to get 20 rupees dividend. Naturally, what is the percentage of return you are getting? 12.5%. 12.5%. Now, rupees in lakhs. Under what method? Market value approach. 100 rupees share traded at 160 in the market, then 400 could be traded at how much? 640 in the market. Am I right? And KD, debt remains the same. There is no any change in the value in the market. Market value, book value same. Term loan also, market value and book value being same. Then overall capital employed in terms of market's valuation. As per the book valuation, it may be totally different. Market value may be totally different. Market value usually 2 or 3 times higher than the book value. Is that okay? You can easily guess. Some companies' market value, no, 10 to 15 times higher than the book value also. Right. So you have to be double cautious. If the company gives you 50% dividend, you tempted. So 50% dividend, then market price may be 15 times higher than automatically 50 by 15. That will be your real return you are getting. See, for an example. Okay. Now, we'll start with a company, TCS. Tata Consultancy Services. You have to understand the difference between dividend per share, dividend offered by the company in terms of percentage, dividend yield as well as dividend rate. Okay. Let's try to understand the Tata Consultancy Services here. Yeah. Now, see here, book value per share is 261.989. Face value per share is just 1 rupee. Dividend declared. Dividend declared. Surprisingly, the dividend information is missing here. Right. But you have been given dividend yield. Dividend yield. Dividend yield is different from the dividend percentage. When dividend yield is given, this is 4.12 percentage offered for the value of the share. Okay. So probably the shares price, what's today's rate? So today's rate probably around 3070. 3070. Okay, we'll assume it is 3050. For 3050, 4.12 percentage will be dividend. Come on, tell me. One. You represent that in percentage. 120. Okay, 125 point. Okay, 125 rupees. Okay, 125 rupees dividend is offered. Whose angle? Investor's angle. If you invest around 3050, you are getting 125 rupees dividend alone per share. Per share. Highly paying dividend. But how it is quoted while publishing in the AGM and board of directors meeting, when you study the AGM report as well as the board of directors meeting report, they will show this when 125 rupees is paid for every 1 rupee share. Then what's the percentage of return the company is offering? Hmm? Hmm? Yeah, calculate. What's the answer? Huh? Ah, you have to calculate. Use the calculators. Very important. No, you to use the calculator. So 1 divided 125 rupees is paid for every 1 rupee percentage. 12,500 percentage is the dividend payment. Very exorbitant dividend, like so. Company will give. Let's see. Cross verify. Sometimes there will be error. Let's check. How can I verify this, sir? Here, corporate action. One tab will be there. If you click, you can see the dividend declared also. Okay, corporate actions. Corporate action. In corporate action, dividends. Okay. Surprisingly very high only due to this reason. Special dividend is announced and final dividend. Exorbitantly high dividend announced. For the year 24-25. Usually any dividend started paying after 1/4/2024 named as interim dividend. Named as interim dividend up to 31st March. 31st March 2025. After that, you may be given final dividend also related to that. So you have to check all these things. So first April after, yes, this one, second interim dividend, special dividend, and final dividend. So these are the amount paid in that 1 year. How much is it? 96, 106, 116. That what we got the message, like 120 or 125 percentage. But the company says that we have offered 12,500 percentage dividend. How? See, we'll see that also. So first you need to understand how to read the statements. As you are being the financial experts, you need to understand how to read the financial statements. Then you can make money out of it easily. Usually, how this is stated in the AGM reports. Okay, AGM reports. Board meetings, right? Quarter results and this one. I'm not given any report here. I need the report announcements. Let's see. Press list. It releases here. Date of payment of dividend. Board approves dividend. If you go and read that board's resolution and their meeting proceedings, okay, rupees 11 per equity share of Indian rupee, INR 1 each. For every 1 rupee shares, 11 rupees is paid. If it is mentioned in sometimes percentage, it may be 11 by 1 into 100. 11 by 1 percentage. 1100. 1100. First interim, first quarter. 4 quarters we have to go, and final dividend is also there. So definitely 12,500. Okay, let's ask that in the chat GPT. Dividend percent offered by TCS in financial year 2024-25. Let's see whether it's answering correctly or not. $126, okay. 12,600%. So, since the face value of each share is 1, the total dividend is 126 rupees, which is nothing but 12,600 percentage dividend. But as an investor, you are not paying only 1 rupee for share. The 1 rupee share is traded at around 3,500 rupees. Actually, you have to invest 3,500 rupees to get this 126. Means, as per your view, you'll be getting anywhere between 4.1 to 4.2%. Okay, so based on the share price, the summary table. This is dividend percentage. This is dividend yield. You have to understand the difference between dividend percentage as well as dividend yield. Clear? Very interesting, right? So if you are not strong with this technical terminology, you will usually make mistakes in investing in the stock market. Okay. Ultimately, you are studying everything only for making money. Use the money properly, right? Let's now get back to this. Clear? So, as the investor's angle, the rate is only 12.5%. Because as per the book value, it is only 400. But the share traded in the market is 60% more than the book value. So, you have to pay 60% higher, otherwise 640. Higher, 640. Is that clear? Now, what about the cost as per this values are at book before tax approach? Before tax approach. In case of equity share, this is 2,240. In case of equity share, K before tax being, before tax and after tax will be the same. So 12.5 will be taken. Okay, this is market value approach. Market value approach. And this one being 12%, this one being 18%. The overall cost in terms of rupees being 640 to 12.5. The ultimate dividend will be the same, 80 rupees. Isn't it? The companies offers 20% as per their company's record, means based on the book value. Investors angle based on the market value they will consider. The rate may be lesser, but the ultimate dividend will be the same. No, here also 80, here also 80 rupees. And debt carries a 48 rupees interest. Here, term loan carries 216 interest. The overall amount payable being 344. 344 rupees is payable for the capital employed of 2,240. Now, as per the book value approach, the cost of overall capital for the company in this case being 15.35. book value before tax approach. Before tax approach. Sir, what happens in case of after tax approach? After tax approach and based on book value. First, calculate the cost. KE as per the book value before tax and after tax both will be the same, so 20 percentage, and KD after tax being 7.2 percentage, and KT after tax being 10.8 percentage. 10.8 percentage. Now, what about the ultimate cost payable in terms of rupees? 20 percentage on that being 80, and 7.2 percentage on 400 being 28.8, and 10.8 percentage on 1200 129.60. The overall value being 238.40 is the overall cost. You are paying 238.4 for overall your book value investment being 2000. For 2000 rupees, you are paying this much. So 11.92 will be the answer here. Okay. Now next we'll approach for the market value approach, but after tax. Right. So what about the K? K after tax. This will be 20 percentage, so 12.5 percentage, 12.5 percentage, and KD after tax being 7.2 percentage, KT after tax being 10.8 percentage. Overall amount cost in terms of rupees. Yes, the value being here 80, and here 28.8, here 129.60. Overall payment being 238.40. Then what about the KO? You have to pay 238.40 for the market value of the company's capital employed, 2240. Their ultimate value being 10.64 percentage. 10.64 percentage. Is that clear? Shall I move on to the next one? Now, marginal cost of capital. Marginal cost of capital. So you have to be very careful in calculating this marginal cost of capital. Try to understand this one here. Z company has capital structure 30% debt and 70% equity. Whatever their capital requirement, if they are supposed to invest 1 lakh rupees for the expansion, 30% may be sourced out of the debt, another 70% sourced out of the equity. The equity could be either shares or accumulated profits already they have, right? So that's how they source. So after this, we'll be dealing with the capital structure in detail. So what's the intricacy of the capital structure and all? So here, each and every level after, the cost may be totally different. So first time raising the fund may be very cheaper. Beyond that, if you want to raise the fund, then the payer, those financing us will always have the problem. So they will scared to invest in your company. So by the time the rate of interest may be gradually increasing. Already you are doing a business, for that your cost of capital, overall capital being 10 percentage, right? Using that fund, your return on investment being 11 percentage. Okay. So naturally you have 1% surplus, as your return on investment is higher than the cost you supposed to invest. Probably 100 lakhs already you invested. Suppose you come with a new project, that project requires another 20 lakhs, and you calculated what about the return on investment. You find that return on investment here being 11.2 percentage. You are very happy that, so you will be getting 1.2% excess. But to raise the 20 lakhs, if you go to the market, capital market, you don't get 20 lakhs at 10 percentage, because the further fundraising. So the investors are very scared. Sir, already we have given, and if you still give more debt, then it will be riskier for us. So if you want further 20 lakhs, for the extra risk, we'll demand some extra. Rather than 10, I need 10.5 percentage. Then what happens here? This time also, the cost of overall capital is lesser than our return on investment. So we are capable of earning money more than their cost. 0.7 percentage net gain will be there. So yeah, of course we can go with. If you go for one more project, which is having a cost of 30 lakhs, and this will give a return of say 11.5 percentage. You are pretty happy that, so you still get more return because of the new project supposed to take. Surprisingly, if you go and start asking the fund, no, they demand 12%. Sir, earlier I get only 10%. No, sir, already we have given 100 lakhs, then another 20 lakhs, so 120 lakhs already given. And giving further money for you will be very riskier, so we scared, so we demand more interest. What is the extra interest you demand? Sir, 12%. 12%, of course, this project is not viable. This project is capable of giving only 11.5%, but we need to pay 12%. It ends up with the 0.5% loss. Naturally, what happens? We have to reject this project. This comparison, return on investment or return from the projects, as well as the cost we pay for raising the fund, usually compare in the capital budgeting decision, investment decision. So we will usually compare with the IRR. IRR is nothing but ROI. Is that okay? If the IRR is higher than the cost we pay, then we can accept, otherwise reject it. Either you can go with the IRR model or NPV model. So you learned that in capital budgeting chapter, right? So here we have the multiple projects to be accepted. Next one being, for accepting every project, we need to raise further fund. While raising the further fund, a level after level, it costs us higher. Right? Though it may be higher, my capital structure decision will be the same. What's that? For each and every 1 penny I raise, 30 paise by way of debt, another 70 paise by way of equity. Right. Now, so the company is considering various investment proposal costing less than 30 lakhs. They have n number of projects. Those projects costing only 30 lakhs. It means I have to raise another 30 lakhs to fund for this. The company does not want to disturb its present capital structure. They don't want to disturb their present capital structure. For every 1 rupee of capital structure, 30% should be debt and 70% should be equity. The cost raising the debt and equity are as follows. If you want to raise another 5%, 5 lakhs, your debt being only 9%, equity being 13%. So if you go beyond that, 5 lakhs to 20 lakhs, debt is also costlier, equity is also costlier. If you want to fund beyond 40 lakhs, and debt is also so costliest, and equity capital also has more cost here. Is that okay? Now, assuming the tax rate is 50%. Tax rate is 50%. Compute the cost of two projects A and B, whose fund requirement being 8 lakhs and 22 lakhs, overall 30 lakhs. So from this it is very clear, we have two projects, project A and project B. Project A as well as project B. And your fund requirement, capital employed, fund requirement being 8 lakhs for A and 22 lakhs for B. If the project is expected to yield after tax return being 11%. If the project is expected to yield after tax return, okay, 11%. it means RY. The RY of these projects 11%. If you want to invest only in A, you invest 8 lakhs and you will get 11%. If you invest only in B, you need 22 lakhs further, you can get 11%. You can invest A and B put together. In that case, you are in need of 30 lakhs, your return being only 11%. Now I had to verify what about the cost requirement, overall cost of capital for every funding options, right? Determine under what condition it should be accepted. So all the questions are there here. Now I had to find out the cost of overall capital for raising further fund, right? Now we have the tax rate being 50%. So this is after before tax, then after tax being multiply with 1 minus t. So this is 4.5. This is 5%. This is 5.5%. This is 6%. Clear? Now, up to 5 lakhs, how do we calculate overall cost of capital? KO, weight of debt, cost of debt plus weight of equity, cost of equity. Is that okay? So earlier case, no. You can calculate this way also. Overall value being 1, 400 being 0.2, 400 being 0.2, 1200 being 0.6. This is called weight. This is called cost. Rather than calculating this tabular model, you can use the formula also. The formula being weight of debt, cost of debt, weight of term loan and cost of term loan, weight of equity, cost of equity. In this case, weight of debt being 0.2, cost of debt being 0.12, 12% or 0.12. Weight of term loan 0.6, cost of term loan 0.18, weight of equity being 0.2, cost of equity being 0.2. Come on, get me the value. 0.173. Are you getting this value? 17? Fractional difference, maybe rounding up, 17.3%. What we have calculated, this one, we got this way. So this is a tabular model. Here we use the formula model. So we multiply the weight and the cost, this one. Okay. This model is followed here because I need to solve in single line rather than creating the table for 4 aspects, right? For the 5 lakhs, up to 5 lakhs, cost of debt being 4.5. Okay, 4.5. So weight of debt being 0.3, weight of debt being 0.3, weight of equity being 0.7. So 0.3 into 4.5% plus 0.7 into 0.13 or 13%. Either you represent in percentage or in decimal completely. Okay. Come on, get me the value here. 10.45%. Okay. Then I'll go for the next option. If you want to raise the fund anywhere between 5 lakhs to 20 lakhs, what happens here? 0.3 should be the debt form. For that, rate of interest being 0.5%. Okay, or I can use the 5% here. Okay, plus 0.7 into 14%. The ultimate value being 11.30%. The next one being 0.3 into 5.5%. plus 70 percentage on this rate 15 percentage. The value being 12.15 percentage. Finally, going beyond 40 lakhs, 0.3 into 6 percentage, 0.7 into 15.5 percentage. The ultimate value being 12.69 percentage. Now, what happens if I want to accept A? I need 8 lakhs rupees. To raise 8 lakhs rupees, I may fall under this option where my cost is 11.30. So ROI is higher, ROI is lower than the KO. Our cost is 11.3 and ROI is only 11. Not advisable to invest here. What happens in case of B? Also 22 lakhs. 22 lakhs means it falls anywhere between these two. 12.15. If you are choosing B, you will be losing more. If you choose A, then 0.3 will be loss. If you choose B, 1.15 will be the loss. Is that okay? So then also rejected. If you choose both, ultimate ROI is only 11, but you are in need of 30 lakhs. 30 lakhs will cost 12.5%. Then also you are losing. Okay, so should not accept. Determine under what condition it would be acceptable. Provided if A's capital employed requirement or fund requirement being 5 lakhs or less than that. In that case, my rising fund cost is only 10.45 lakhs, 45 percentage. My earnings is 11 percentage. Definitely we can choose. This is the option you can choose. That's why you have to study marginal cost of capital concept for the investment decision. It is not based on the existing cost of capital, go for investing in further projects. Okay, if you want to go for investing in further project, what is the incremental cost of capital? You have to find out that and then compare the incremental cost of capital with your return on investment on the new project. The incremental cost of capital is called marginal cost of capital. Okay. We have the other method also, right? What's that other method? If I need of only 8 lakhs, up to 5 lakhs, I am getting this rate at the rate of 10.45. Another 3 lakhs, I can raise the fund from this block. If you understand that block, two ratios are there, right? Okay. As per the tax slab, what happens? If your income is 10 lakhs, up to 2.5, nothing is there, thereafter 5%. That's how we calculate. Another case, if you are earning 10 lakhs, you have to pay flat rate 20%. Like the moment you cross the limit, you have to pay the tax. Same happens. The moment you borrow beyond 5 lakhs, then you have to pay 11.3 is one of the approaches I saw in that approach. There is another approach. As I am in need of 8 lakhs for funding A, first I borrow 5 lakhs. If I borrow first 5 lakhs, my cost is 10.45%. Thereafter, I borrow another 3 lakhs. By the time I may move on to the next tax cost being 11.30. Yes, now what about my total cost payable? 5 lakhs into 10.45? 52 point 5 lakhs 52,250. Here 900. What is the total payment you are doing? And what is the cost for 8 lakhs? 86,150 you are paying for 8 lakhs. 10.77. Okay. In this case, of course, naturally you can accept because A gives you 11% return. For rising fund to the extent of 8 lakhs, my cost is only 10.77, ends with the 2.23 gain here. Can I use the same logic for B, sir? Yeah, of course you can try. For rising another 22 lakhs. How can I calculate? First 5 lakhs. at the rate of 10.45, 50 to 250. Second 15 lakhs, 5 to 20 lakhs. For 15 lakhs, it cost us me 11.30. Thereafter, another 2 lakhs, I can raise at this rate 12.15 percentage. Tell me. Huh? 69,500. Next. 22,300. 24,300. What is the overall cost you are paying for overall fund requirement? 2 lakhs 46? 50. So 2 lakhs 46,050 for your 22 lakhs of investment. 11.19%. Then accepting B is not advisable. Naturally, if you go for accepting A and B also, not acceptable. So you have to choose only A. Can I choose either A or B or A and B? I have to choose only A. Clear? Come on, make note of it. One of the comprehensive illustrations. Question number 14. XYZ Limited has the following book value capital structure. So this is all about book value capital structure. Okay. Now, we have been given equity share capital 10 rupees each, fully paid up at par 15 crores. Face value being 10 rupees. Overall value 15 crores. I may convert that into lakhs, 150 lakhs. 15 crores, 1,500 lakhs. What is the number of shares? 150 lakhs. Book value being 1,500 lakhs. Am I right? In lakhs. In lakhs. 11% preference share capital. Face value being 100. 1 crore. 100 each. Then how many shares we have? 1 lakh shares worth being 100 lakhs. Retained earnings 20 crores, otherwise 2,000 lakhs. 13.5 percentage debentures. 100 each. 10 crores divided by 100 each. 10 lakhs. 10 lakhs debentures, right? You have 10 lakhs debentures, value being 1,000. 15% term loan, 12.5 crore, otherwise 12.5. Okay, 1,250 lakhs. 1,250 lakhs. The overall book value of the company being 5,850. 5,850. Is that clear? Now, what are the requirements are there? The next expected dividend on equity share per share is 3.6. The dividend per share is expected to grow at the rate of 7%. The market price per share is 40. So you can calculate the KE here. These are the details we have for calculation of other things. Okay. This one is for KE calculation. Preference stock details there for KP calculation. Debenture details is for KD calculation. Tax rate being 40% required. Calculate the weighted average cost of capital, overall KO, under book value as well as market value proportion both. Come on, join with me to solve all these things. First, we have to calculate the cost for every source of fund. Thereafter, we can calculate completely. Overall can be calculated later on. Let's start with the first one. This is all about KE calculation. KE as well as per book value approach. So dividend detail is there, growth detail is there. Then automatically what happens? We have to use the constant growth. Gordon's growth model will be used. KE is equal to D1 bar P0 plus G under book value approach. As per the book value approach, D1 being 3.60 and book value of the share per share value being, how much is that? So I can, rather than book value, I directly go for market value approach in this case. Right. So D1 in this case being how much? 3.60. P0 being 40 rupees and G being 7%. What is the ultimate value? 16%. Clear? 16%. Now we'll calculate what next? KP. Redeemable after 10 years is currently selling at 75. So redeemable. In case of redeemable, what is the formula here? Preference dividend plus redeemable value minus net profits today divided by number of years for redemption purpose, overall divided by redeemable value plus net profits by 2. Is that okay? So preference dividend being 11% preference share. So then for every 100 rupees, 11 rupees will be the dividend plus redeemable value being 100. If nothing stated, we assume it is going to be redeemable at face value. Net profits being currently it is traded at 75. We get only 75 today. The redeemable period being 10 years. Overall divided by redeemable value 100. Net profits today being 75 divided by 2. Come on, get the KP here. 15.43%. Okay. 15.43%. Now let's move on to the debenture case. Debenture has tax impact, so we have to consider the tax here. KD is equal to interest into 1 minus T. So two options are there. That 1 minus T can be used immediately after R, or With the complete formula, you can multiply with 1 minus t last. So I use that 1 minus t immediately after I. Okay. Plus redeemable value minus net profits by n whole divided by redeemable value plus net profits by 2. Here the answer being 13.5 percentage for every 100 rupees. Then interest will be 13.5. Tax rate being 1 minus 0.4, 40 percentage. So 40 percentage is subtracted. Plus redeemable value being face value, nothing stated means. Then today's recoverable value is only 80 on selling, and redeemable after 6 years. So in denominator it's 6 whole divided by redeemable value 100 plus net profits 80 by 2. Is that clear? Then what is ultimate value? Is it 12.7? So 12.7 is the answer. So we have copied all the values here. Now, what about the cost here? Cost in this case being for equity share capital 16 percentage, preference share capital 15.43 percentage, retained earnings 16 percentage. The equity share capital value will be directly taken for that also. That's also their share. In case of debentures, 12.7 percentage. In case of TL, cost of TL, irredeemable. In case of irredeemable, what happens here? Cost of term loan, interest rate multiplied with the 1 minus t. That's all. So 15 percentage into 1 minus 0.4, 9 percentage will be the value. 9 percentage will be the value. Clear? Now find out the cost. Cost in terms of rupees. For equity shares, 1,500 lakhs, right? So for that, 16 percentage dividend will be payable. 1,500 into 16 percentage, what is the value? 240 you have to pay. In case of preference shares, 100 into 15.43. 15.43 preference dividend is payable for the preference shareholders. For debenture holders, for 1,000, 12.7 percentage will be payable. 16 percentage on 2,000 will be calculated first reserve fund. 320. And for debentures 1,000, for that 12.7 percentage will be leviable or payable 127, and 9 percentage on the term loan. 9 percentage on the term loan 11. Okay, 112.5. Come on, get me the total value. The overall value payable for all this capital, 5,850 rupees capital, for that the cost being 814.93. Then find out the KO, cost by book, means investment. So 814 divided by 5,850. What's the value you are getting? 13.93 percentage. So we have completed the book value approach here. Now, in case if you want to calculate under market value approach, how this will be? Now, market price. For equity share, today's market price is 40. Preference share saleable at 75. Debenture saleable at rupees 80. Is that okay? So if you take the market value and calculate the overall investment based on the market value, that is called market value approach. Right. The main point to be noted here is you don't have separate value for the reserve fund because the market value always comprises the reserve fund also. Investors are very aware about the accumulated profits of the company. If the company has more accumulated profit, they are willing to pay more price for the share. 10 rupee share traded in the market at 30 or 40 rupees only due to the accumulated profits and future growth. So you don't have the separate value for the reserves and for surplus in market. So total it up and find out the value completely. And in case of term loan, of course, it will not have any value difference. So market price and market value. Price is nothing but per share or per debenture basis. Value is nothing but total value, number of shares multiplied with the market price per share. So how many shares are there? 150 equity shares are there. Per equity share traded in the market rupees 40. Now you just multiply these two to get the value. 6,000. And here 75 into 1, 75 lakhs. This is not applicable. And 10 lakhs into 80, 800 lakhs. And here the term loan remains undisturbed, 1,250. The term loan remains undisturbed, 1,250. Clear? Now, what you have to do? Calculate the cost. Cost in rupees. What's the total, come on? 8,125. And find out the cost here. Cost in rupees. You have to multiply this cost with the market value. 16% on 6,000 being 960 and 75 into 15.43 11.57. Not applicable for this. In CA text, no, they have segregated this value for equity shares and reserve fund. By segregating also, you will get the same number. Okay. 1,500 equity shares, 2,000 reserve fund. You know, this 6,000 is shared in the same ratio. 3/7 for equity, 4/7 for reserve fund. By applying that way also, you will get the same answer. Okay. Isn't it? Naturally. 6,000 into 3/7, how much is that? 571. 4/7 being the balance value, 3,429. If you multiply the cost of equity capital with this 16 and 16, you will get the same answer. Okay, so don't worry about the splitting or non-splitting, no issues. But if you go and refer your CA text, you should not get confused. See, understand the same logic is there. Okay. Now, this one. 1.60 and finally 112.50. Overall cost we pay for 8,125 being 185.67. Come on, get me the percentage here. So you have to use these two values to get the KO. 14.59%. Clear? In illustration, the first part is over. Second part is to calculate the marginal cost of capital for incremental funding. Okay, second part, this part. Okay. If you are thorough with this, let me know so that we go for the next one. Come on, make it faster. So with that illustration, we'll complete the cost of capital completely. Then we'll move on to the capital structure chapter. Okay. Clear? Define weighted marginal cost of capital. Okay. So weight cost of capital, you know that. Okay. Overall cost. Marginal is nothing but incremental cost. If it rises 10 crores next year, given the following information, they want to raise 10 crores in the coming year. The amount will be raised by equity and debt in equal proportion. So 50-50. 50-50. Okay. 1:1 ratio. Debt is also 1 rupee. Equity should also be 1 rupee. The company expects to retain 1.5 crores earnings next year. Is that okay? They can retain 1.5 crores the next year also. Clear? It means retained earnings can be used. What is the cost of retained earnings? What is the cost of retained earnings? The cost of retained earnings is nothing but KE if nothing stated. KE as well as KR both are same. Additional issue of equity share will result in the net price per share being fixed at 32. What happens if you want to further raise the equity shares? The price will be only 32. What about the current market price? 40. 40 decreases to only 32. Then automatically the KE will be totally different. Is that okay? Let's see here. In this scenario, KE, cost of equity new, D1 being 3.6, but new issue priced only 32 rupees and add 7% for the growth. Then overall value being 18.25%. This is what about the new KE. New KE. Clear? So for 1.5 C, otherwise 150 lakhs, your cost being existing one. What is the existing one? 16%. Further rising, additional to that, it costs me 18.25%. I'm in need of 10 crores, am I right? Otherwise 1000 lakhs. For the overall fund requirement, debt to portion being 500 lakhs, equity portion being 500 lakhs. In this 500 lakhs, first 150 lakhs will cost me how much? The existing value because current rate. For the remaining value, 350, no other way, we have to go for fresh issue. If we go for fresh issue, the cost is totally different. This is 18.25. 18.25. Similarly, I have to raise fund for debt portion also. The debt capital raised by way of term loans will cost 15% for the first 2.5 crores and 16%. In that first 250 crores, it cost us me 15. Always remember, you can take KT after tax, tax being 40%. So you can subtract the 40%. So you have to multiply with 0.69% for the first 250 lakhs fundraising. The additional 250 lakhs fundraising, it cost us me how much? Into 0.6, 1 minus T, into 1 minus T. So it cost us me 9.6, 9.6. Is that okay? Now, what is called marginal cost of capital? Incremental cost of capital is called marginal cost of capital. Incremental means for each and every slab you have to calculate separately. Provided you have to keep the idea in your mind. What's that? The ratio should be the same. Debt equity ratio should be as per the company's requirement, 50-50 or 60-40, whatever it may be, it should be maintained. But slab wise you have to go. Slab wise. How can I proceed, sir? Listen carefully. This is the base for calculating the thing here. So you have to raise whatever the amount may be equivalently for debt as well as equity. Now, which is the cheapest one? Which is the cheapest one? Okay. So among the four values, the lowest value is what? 150. I'll now consider the 150 debt, 150 equity will, okay, I think this is equity, this is debt, right? Okay, this is equity, this is debt. Okay. So equity 150 I have to rise where it is cheapest one. Provided debt and equity should be equal ratio, right? So I assume 150 also be from debt. Clear? See here. I'll write down that here. Equity. 16% equity. I can rise up to 150. And 18.25% equity. Another 350 can be raised. Similarly, in case of debt, 9% debt can be raised to the extent of 250. Another 9.6% can be raised for another 250. So what can I do? If I take 150 rupees equity, the same 150 should be in the debt also. I assume among the four, this is the lowest one. So I assume this is going to be raised 150 equity. As equity 150, I have to raise debt also 150 rupees. From where? The cheapest one 150. The cheapest one 150. Clear? After for first rising, thereafter, what is the balance you have? 0, 350, 100, 250. Now what is the cost for this much of fundraising? Means first 300 lakhs. First 300 lakhs. What about the K here? What about the KO? What about the KO? KO for this being weight of equity into cost of equity plus weight of debt into cost of debt. So equity being weightage 0.5, cost of equity being 16% or 16%, plus weight of debt being 0.5, cost of debt being 9%. Come on, what's the value? 12.5%. Clear? 12.5%. Next, I have to take next slab. Here, which is the lowest value? 100 is the lowest value. I take 100 from the debt. Equivalent 100 should be from equity also here. So next slab is this one. After this, the balance being, this is the first one. For that, the cost being, overall cost of capital in this case being 12.5. Up to 300. Next being 100 here, 100 there. Why not 120? 120 naturally what happens? 100 from 9 and 20 rupees should be from 9.6. There is a trouble. If you take 9%, you have to finish up 9% completely. So here 100, here 100. Second option. From 350, 100 is subtracted, so 250. From 100, 0. So now still you have 250 by way of equity, 250 by way of debt. But anyhow, second combination, you have to calculate that. So for the second 200 lakhs, KO being 0.5 into the equity rate being 18.25%, plus for debt, it is 9%. What is the ultimate value? 13.625%. Okay. Then finally, you can go for the balance. Balance sum. Balance 500 lakhs. Are you getting this value? So for the balance, it's 0.5 into 250 plus, 0.5 into 18.25 plus 0.5 into 9.6. Now the rate of interest also increases. This one has 9.6 percentage. This one has 18.25 percentage. So I am taking these two rates for the last fundraising. Now here the ultimate value be 13.925 percentage. So the marginal cost of capital gives you an opinion whether we can go for further projects or not. If further project costs me, say around ROI of the further project costs me 13 percentage, can I go for this or not? You have to cross check whether the fund requirement is less than 300 lakhs or more than 300 lakhs. If it is less than 300 lakhs, this will be my benefit. 12.5 will be my cost and 13% is the ROI, definitely I can accept. Suppose if the fund requirement being not 300 lakhs, it may be 10 or 1000 lakhs. In case of that 1000 lakhs, I am in need of 13.925% for compensating. Definitely it's not acceptable. Clear? Or you can add up all the six. You can add up all the six. Okay. How can you add up all the six? In this case, the last case, if the ROI of a project, ROI of the project being 13 percentage, and fund requirement being less than or equal to 300 lakhs. Naturally, what happens? 300 lakhs can be raised with a cost of 12.5. We can accept. This is project A. In case of project B, sir, it costs you 13.75 percentage. ROI being 13.75. But fund requirement being 1000 lakhs. Now my question is, can I accept this or not? 13.75. Fund requirement being 1000. Can I accept this or not? For the first 300 lakhs, my cost is 12.5 percentage. 37.5. For the next 200 lakhs, my fund requirement be 13.625 percentage. Yes, come on, tell me. 27.25. Okay. Then for the balance 500, it costs me 13.925 percentage. Come on, get me the ultimate value. 69.625. The overall fund 1000 lakhs, we have to pay so much cost. What's the value? 133.75. Otherwise, for that entire value, 134.375 is payable for 1000 rupees of fundraising. 13.4375. Otherwise, 44 percentage. Yes, this cost being the return on investment is 13.75. Of course, we can accept. Clear? For that only marginal cost of capital is required. Now, a challenge for you. Okay. This ratio, rather than equal proportion, if it is being 60-40, how about the calculation? Try it yourself at your own home. We'll discuss that later. Finish off copying. So we'll have a small break and resume for capital structure after the break. Capital structure and financial structure. You have to understand the difference between these two first of all. Only the long-term finance will be considered in capital structure. In financial structure, you will consider all the left-hand side of the balance sheet, means liability side. Okay. So in your balance sheet, you have equity share capital and resource and surplus, preference share capital, non-current liabilities, current liabilities. Studying this one is called capital structure. Studying this one is called financial structure. Is that okay? Now, for the fund requirement of any business, usually named as capital employed, could be sourced from long-term finance and equity. Okay, equity share capital, resources surplus, and preference share capital and non-current liabilities. Capital structure. How the capital employed is financed, whether it is purely equity shares or a portion of retained earnings or preference shares or non-current liabilities, and all are combinations. Okay, that's going to be studied here. In what proportion, if you are mixing all these things, so that overall cost of capital to the organization will be cheaper, or returns given to the equity shareholders will be higher. That's the intention. So you know that the cost for the equity share capital being KE, KR, and this one being KP, and this one being the KD. Each and every component will have its own cost. So you want to source based on the cheapest one. In general, KD is the cheapest and KE will be the costlier. Okay, naturally. So then you want to source out of the cheapest fund or costliest fund. Your first priority goes to source your fund requirement using the cheapest one, cost of debt. But the problem is riskier. So risk will be high. And low. Your cost being 10%, your return being 15%. Pretty happy you can save 5%. Suppose if your return falls down to 5%, what happens? In this case, you are happy with 5% plus. In this case, you are unhappy as you are losing 5 rupees. Is that okay? In case of cost of debt. In case of cost of equity, though the demand is higher, if you earn 15, you pay 5 rupees excess, they will be pretty happy. But if you earn only 5 rupees, yeah, of course, they will be unhappy. But anyhow, you no need to pay additionally. So once you earn, you can pay the dividend. If you don't earn any profit, you don't pay anything. You will be safer. But of course, market value of the share will go down if you are not making good profit. But that doesn't matter. Any of the amount already collected will be safer. You are not going to refund that. Okay. The market price may be totally different. Depending upon the company's earnability, the market price may be affected, but you are safer. But in case of borrowings, no. You have to somehow arrange the debt interest for the debt and you have to pay where existing equity shareholders fund will also go off. There's a risk. So high risk. Though cost being low and this one is high, but risk is also be inversely related. Debt finance will have the high risk but low cost. Okay, in case of equity, we will have the low risk with high cost. Clear? Then we need to have a trade-off between risk and return. Risk should also be moderate and return should also be inflated. That's what about the case. Okay. So mixing this ratio will be so optimum to the company as well as shareholders, the predominant motto of the company in capital structure decision. Okay. In capital structure, the composition of long-term funds in capital of the company is going to be studied, such as debentures, long-term borrowings, preference shares, equity shares, and retained earnings. Financial structure is nothing but the entire left-hand side of the balance sheet, which represents all long-term and short-term source of capital. Thus, capital structure is only a part of financial structure. So, only a part. Okay, financial structure, in that the capital structure being a part, another being current liability structure. Is that okay? So, already I told you. Okay, so we have the equity and debt. If the equity portion is high, then what happened? Your risk is also low. Your risk is low. And return is, in this case, not return, cost. Okay. Cost is also high. And when you are sourcing out of debt, risk is high, cost is low. But my intention is anywhere between these two. Right. So, capital staking is nothing but a graphical presentation of a capital structure. Layers of capital. common equity, preferred equity, and mezzanine debt, senior debt, junior debt, and senior debt. Is that okay? Potential risk and return. Potential risk and return. Clear. Will be also having the impact. Will be having the impact. So, high cost, low cost, and when you are adding senior debt here, no, automatically there will be huge risk. Huge risk. This is called capital staking, just for understanding. Just for understanding. What about my intention by studying this capital structure? Minimum cost of capital, as well as you have to maximize the value of the firm. That's what about the ultimate goal of the company. Then what are the factors are there to consider for deciding the capital structure? Do you want to minimize the risk? Yes, then you need to finance out of debt lower. You have to finance predominantly equity. If you want to have good control, then also you need to have more equity. Okay, or out of 100 shares, I have my own shares 60, means the promoters. Balance 40 will be the outsiders. If still they need another 100, if they raise the 100 by equity share, what happens then? The equity share capital being 140, my share being only 60. As my share falls less than 50%, my control will be lost. Rather than what we can do, let the equity share being the same 100, the additional 100 can be raised by way of equity. So then the management will still retain the 60% shares, they will have the voting rights and the controlling rights. So to understand, to maintain the control also, the capital structure will be framed. Flexibility. If you are raising the fund by issuing equity shares, when you are not in need of that fund, no way you have to retain that, because refunding the equity share capital will be a lengthy process. You have to go for the buyback process and all. But in case of debt, if you have the further fund, you can simply settle this, repay this, that advantage you have. So flexibility of changing the fund requirement will be a reason for deciding the capital structure, and profitability as well as solvency. So if you want to make good profit, then you have to source fund using the debt. And if you want to be solvent position, you should not have any tension of repaying this. Then you have to source the fund by equity. So these are the 5 factors are there for deciding the capital structure also. Clear? Now, the predominant theories that we study in capital structures, theories. Okay, we have capital structure, a relevance in the market value or not relevance in the market value. 2 links are there. Some others recommend, sir, no issue, sir. Based on the capital structure, you can simply inflate the company's image. Some others recommend no. Whether you change the capital structure or not, the company's image remains the same. Already told you, no, in dividend decision. In dividend decision, dividend relevance technique, dividends irrelevancy. In case of Gordon's growth, Walter model, even Graham Dodd and all, no, they profound the ideas based on the dividend has a relevance over the company's price of the share. Modiglin Miller is just reverse. Sir, no sir. Whether you give the dividend or not, the company's image same. Similarly here, we have net income approach, net operating income approach, traditional approach. So we have net income approach. Okay, net income approach says capital structure relevance. Okay, capital structure relevance means what happens? It has the impact in the value determination. And net operating income approach, this one says, sir, irrelevant, sir. Okay, company's image remains unaffected whether you change the capital structure or not. Is that clear? That's what about the logic of these two, NI approach, NY approach. Net income approach says, based on the capital structure, your value may increase from 100 to 150 if you are increasing the capital structure. This is what about NI approach. NY says, sir, whether you borrow or raise equity shares, issuing the shares or some other mode, whatever it may be. Earlier also 100, even after sourcing, the value being same 100. Okay, these are the 2 views. NI says the capital structure decides the value of the company. NY says no, sir. Whatever the capital structure you have, okay, probably 50-50 debt equity, and here 60-50, 60-40. If you are raising the debt and reducing the equity, the value will increase. Is the approach of NI. NI says no, sir, there will not be change. Okay, what could be the structure? 50-50, 60-40, 70-30. Okay, that structure will have impact over the value of the company. The value of the company may be 100 lakhs, becomes 150 later on by changing the capital structure. Changing the capital structure is nothing but increasing the debt ratio, increasing the debt ratio. Is that okay? See, debt equity ratio. So this may be 30 debt to 70 equity. If you are reversing that 70 debt to 30 equity, definitely net income will, as per the net income approach, the value will increase. Value will increase. Why? Debt has lower cost. You earn 10 rupees, but you are paying only 3 rupees for the debt. But equity shareholders, for the 10 rupees earning, they may demand 11 rupees or 12 rupees. Okay, we earn and pay lesser and we save money. Because of the accumulation of the savings, the company's resource, the company's image will increase. That's the argument of NA approach. NY says no, sir. Whether it's a 30-70 or 70-30, there will not be any change. Okay, so this is one approach. This is another approach. Clear? This is another approach. For example, we have 5 students. Okay, I thought to give around 4 chocolates each. Okay, 4 chocolates each. 5 students and 4 chocolates. So I brought 20 chocolates. So I am very comfortable to bring 20 chocolates. Okay, suddenly what happens, 2 students are saying, sir, I am sugar patient, sir, I don't want. Then I am pretty happy then. 2 students. 2 students, okay, anyhow you brought me, sir, I will take just only 1, sir, not 4. Remaining 3 students, no, they will be given 4 chocolates. So 2 plus 12, 14 chocolates, and out of 20, 14 is used and balance 6 is retained. If there is a retained earnings, company's image will be increasing. Right. So Amrita is very happy. So 2 into 1, sir. 2 chocolates, sir. 3. Balance how many chocolates, sir? We have 20 chocolate. No. Give the entire 20 to us. 3 into what? Balance 18 chocolates, right? Balance how many chocolates are there? 18 chocolates. So we'll share, sir. Rather than 4, we'll take up 6. So end up with no savings in my hand. Why? Why? Because this will be called a debt. This will be called a debt. Okay, equity shareholders demand 4. Debenture holders, sugar patient, demand only 1. Right. So I thought I may give 4 for all, but there is a small correction. Somebody will take only 1. Okay. So by giving just 1 to these 2 debenture holders, I will spend 2 rupees. Remaining 4 rupees will be payable for the 3 equity shareholders. So 14 will be the overall spending, 6 rupees saved. This is called NA approach. This is called NA approach. But no, what happens in case of NY approach? Sir, no, sir, by adding the debt component, rather than paying 2 into 4, 8, you are paying 2 into 1, only 6. Sorry, only 2. You are saying 6. You are saving 6. But by adding the debt component, indirectly, equity shareholders' risk is increasing. Isn't it? So if this is purely equity share company, equity company, what happens in case of loss, or if in case of no profit, no loss, equity shareholders will get nothing. If you include debenture component, if there is no profit and loss, definitely you have to pay interest for them out of whose money? Equity shareholders' money. So by adding the debt component, equity shareholders will face the risk. Immediately they say, no, sir, if you add the debt component, our requirement is not 4 chocolates, our requirement is 6 chocolates. How? It's very simple. See, cost of debt Okay. What we supposed to give? KO. KO is nothing but our earnings. This 4 chocolate will be KO like. KO, KD. I save rather than giving 4, only 1 means 3 chocolates saved. 3% saved per debenture to the extent of debt ratio, debt by equity. Debt by equity. This is the savings. What is the savings? KO is the chocolates I plan to give. KD is the chocolate taken by the debenture holders. Okay, clear? Now, this will be taken by whom? Equity shareholders. KE is equal to, sir, how many chocolates brought for me, sir? 4. By saving yourself, mixing the debt. Okay. You brought 4 chocolates for debenture holders, but they have taken only 1, so 3 you save. For how many people? To the extent of debt to share. Okay, this much you saved, no? To the extent savings will be risk for me, share to me, divided by equity. Who is going to take this? Equity shareholders will demand and take. See, I brought around 4 per head. But 4 minus 1, only 1 is taken, 3 not taken. By whom? 2 debenture holders. Those savings is taken by whom? Equity shareholders. How many equity shareholders are we still have? 3 equity shareholders. So out of 5 students, 2 are debt, 3 are equity. 2 students taking only 1 rather than 4. There's a savings 3 per head for 2. 2 into 3, 6 is saved. That will be taken by the remaining 3 equity shareholders. So divide that by 3. So what is the ultimate value? Ultimate value 6. Ultimate value. So equity shareholders will demand 6. Yeah, debenture holders will be demanding the same 1. Okay. I thought your demand is only 1, no, I will give. Your demand is only 4, no, okay, I will give. But debenture holders may be cheaper. Equity shareholders may be costlier. But when you mix the debt component there, equity shareholders will be double cautious. Their demand still increases further. To what extent? KO plus KO minus KD savings to the extent of D is shared by the equity shareholders. That I need. So, company ends up with no savings. No savings will not give any rise to the company's image. That's what about the argument of NY approach. So, 2 approaches. One approach says that what the equity shareholders offering, means demanding, will offer. What the equity debenture holders are demanding, will offer them. Both will be constant. But NY says, no, sir, when you mix the debt, automatically equity shareholders' demand will be rising, so company will have no leftover reserves. So the company's image will not be increasing. If I give the 2 choices, what about your opinion? What about your opinion? Will the value increase or will not increase? If I ask you the question, what will be your answer? Sir, you confused with both the solutions, sir. No change and there is a change. Then Modiglin Miller came. I will now vote for this. Modiglin Miller says, sir, NI will be correct one, not NI. NY is correct one, not NI. That's how he started with. If I am giving you 2 choices, what's that? Will the capital structure have any impact over the company's value or not? Yes, sir. No, sir. Okay. What's your opinion? Do you want to rank whether it's yes or no? So then Modiglin Miller directly comes, sir, irrelevant, sir. I'll vote for NY. Then he proved his view, why it is not irrelevant. He proves with mathematical calculations and all in an open forum. The next day, then suddenly all the open forum members started arguing with him. Sir, it's totally waste and nonsense. What you talk about is not real life illustration. We will not accept for that. As lots of criticism is there, no, then reworked and he too accepted. Okay, pa, it is also relevant. Okay, so what happens? NA approach, NY approach. This one being relevance. Relevance means value will increase. This is irrelevance. Value will not change. MM comes. He says this one is correct. Value will not change. After lots of criticism, he immediately shifted, okay, this is also true. NA approach, capital structure relevance. NY approach, capital structure irrelevance. Then he voted for capital structure irrelevance only, correct, which is called Modigliani-Miller model without tax. Lots of criticism came. After reworking, he then realized that this will not stand correct. So again, he shifted to this. This will be called as Modigliani-Miller with the tax model. With tax model. Is that clear? So he starts proving with his own mathematical calculation, this one is true. While presenting, then the various observer attended the meeting, immediately criticized his own theorem. Then he recalculated and then he shifted to the NA approach. So we have two approaches. Between these two, it's not NA or NY. It is not NA or NY. It is anywhere between halfway through. That's called traditional approach. Don't say there will not be change. Don't say there is change. It's a midway. Always midway. Have you studied perfectly? No, sir. Have you not studied? No, sir. So what's your answer? I studied, sir. I don't know will I pass or not. So that's how the mid-range you are having. That mid-range is all about traditional approach. Hope you will be able to now understand NI as well as NY approach. Clear? So we have to cover up these 5 approaches. With that, capital structure will be completely over. For these 5 approaches, no, I'll give a small format that will be very friendly to understand. So that format is given here. Is that okay? This format is very interesting. I have given this format. When it is all about capital structure, keep this format and feed the data, automatically you get this. Okay. Nine-line approach. 9-line approach. Come on, tell me. What is the formula for KE? In normal case, what is the formula for KE? Normal dividend. Okay, dividend by equity. Dividend by price per share. You can calculate the price of the share, KE of the share this way, or what you can do, rather than price, you can take complete equity, right? In that case, complete earnings available to the equity shareholders, right? So, earnings available to equity shareholders being 1000, number of shares being 100, and EPS being 10. Okay, EPS being 10. Clear? Price per share being 50. What about the KE? EPS by P, 10 by 50. 10 by 50. Then the value being 20%. Can you use this one? Earnings available to the equity shareholders divided by equity. Earnings available to the equity shareholders being 1000. What is the equity value? 50 rupees per share, number of shares being 100. So 50 rupees per share into 100 shares. Then equity value being 5000. You represent that in percentage, you will get the same 20%. Clear? You know that earnings before interest and tax 100. From that you have to subtract what? Interest first of all. Probably if we have interest say 20 rupees. Then 80 rupees is called EBT. From there you can subtract the tax, probably 40% tax we assume. 32 is subtracted, balance 48 is called as EAT. Okay, if we don't have preference share, then EAT becomes what? Earnings available to the equity shareholders. Is that okay? So from that you deduct what? Preference dividend 0. Then the final value being earnings available to the equity shareholders. Assume that if I don't have preference dividend, then EAT and the earnings available to equity shareholders are same. If you don't have tax, So EBT and EAT are same. Clear? Clear? Lots of confusions, especially when you study FM. Somewhere it may be EBAT, somewhere it may be NY. So what is that? Some new NY comes here. This EBAT is named as NY. This earnings available to the equity shareholders is named as NI. Hope now you'll be able to understand easily. I'm linking with the existing format. Don't worry. After this, I'll go for the leverage chapter. After that, I'll straight away go for the ratios analysis. In ratio analysis, I'll give the complete format, starting with the sales, subtracting the cost of goods sold, operating profit, and earnings before interest and tax, EBITDA, and all the things we'll be studying along with the ratio analysis. I request you to understand the format and the terminology wherever we go, and we'll use that only. In that format EBAT minus interest, EBT minus tax, EAT, from there preference dividend is subtracted, you will get earnings available to the shareholders. The same when it's all about capital structure decision making chapter, EBAT is otherwise named as NY and earnings available to the equity shareholders named as NI. You know that what is the formula for KE? Earnings available to the equity shareholders divided by equity. This is named as what? NI. Okay. So, in simple, NY is nothing but EBAT. NI is nothing but earnings available to the equity shareholders. No tax, no preference dividend. In general, while studying the capital structure chapter now, predominantly we assume these things. What are they? We don't have the tax, we don't have the preference shares. As well as NY is equal to the EBAT, NI is equal to earnings available to the equity shareholders. The tax will be included only in Modigliani-Miller approach. That too, second approach. First, he voted for this one, right? Second, after lots of criticism, he started including the taxes. After including, this becomes capital structure relevance model. So only here we are going to study the tax. Until that period, we never bothered about the taxation. Clear? So this is the main aspect you have to keep in your mind. Come on, tell me. What is the formula for KE? The formula for KE in this case being net income by equity. What about the formula for KD? Interest by, we usually take net profits, but rather than here you can directly take the T. And what about the KO? KO is nothing but weight of equity and cost of equity plus weight of debt plus cost of debt. Is that okay? Or what you can do? What you can do? Equity into cost of equity, debt into cost of debt. You have to multiply these two and do the summation. You do the summation. Or the summation of this is what? Value. Company's full value. These two put together will be called as what? Overall cost of capital. KE and KD put together will be KO. Equity and debt put together value. So the KO in this case is equal to these two put together. Equity is earning, debt is earning. If you are considering both, then it is called NY. It is called NY. So the formula being NY divided by V. NY divided by V. Clear? Yeah, let me complete this. KE is equal to NI by equity. KD is equal to interest by debt. And KO is equal to NY. NY represents NI and interest both put together in the numerator divided by equity and debt both should be in the denominator value. How do you calculate equity, debt and cost for equity, equity cost, debt cost? What do? You add up this one, this is called value, add up this one, this is the cost, overall cost for this. So this cost divided by value is the percentage. That's how we calculate it. So hope now you will be able to understand this topic. You have to study along with what? Okay, cost of capital. So this is the sequence. FM, once you plan to study, finish up time value of money, and then one after one, the sequence you have to follow the same way how I teach you. Okay, time value of money, then cost of capital, dividend or dividend and capital structure. Sorry, cost of capital, both are interchangeable. Then come to the capital structure, you will get full grip over this chapter. Okay, and of course, investment management, capital decision, capital budgeting decision, right? Now, come on, tell me, what about the equity, sir? You write the formula in inverse way. Come on, equity is equal to NI divided by KE. Then debt is equal to KD and V is equal to KO. You know that if you add up these two, you'll get what? Value. So you can find out either by adding equity plus debt is equal to value, or NY and KO is given, then also you can calculate. Whatever the available information, you can have this as a base and you can calculate. So three line in between here, NY minus interest, then you will get NI. Actually what? EBAT is nothing but NY minus interest, you will get EBT minus tax, you will get EAT minus preference dividend, you will get equity. Earnings available to the equity shareholders. This will be called as NI. Which one? EBAT is called NY. Earnings available to the equity shareholders is called as NI. But anyhow, we don't have the tax and preference dividend. Then you can merge these two, EBAT and EAT, into what? Earnings available to the equity shareholders. That's how the third block is also we are in. Clear? Now see here. NY minus interest, you will get EBT. KE is equal to NI by E. KD is equal to I by debt. KO is equal to NY by P. Equity, debt and value also be arranged here. 9-line format. Now, who gave the idea about NI and NY? Both are propounded by the same person, David Durant, who only coined either this approach or that approach. Later, Martin Miller supported NY. Later, he himself got reversed his own opinion because of criticism. Right. Now, main idea that you have to keep in your mind is what? In NI approach, what are the things we have? NI approach, KE, KD, KO. What did I tell you about NI approach? By including the debt, company can save. That's how I told you, no. I think to give 4 chocolates per student, but some students refused. Sir, I take only 1. Then company thinks I can save 3. Okay. So it means it's a savings to the company. Means equity shareholders will take up the same, no change or constant. Debt, they demand the same 1 chocolate, will be constant. Because of adding the debt, their requirement is lesser. As I'm capable of earning more, that extra earning will be company savings. So this will be changing. But in case of NY, what happens, debenture holders will take the same constant, but equity shareholders' demand will be increasing. Sir, debt is there, it's a risk, so I need more. Then automatically this will be increasing, changing. Because of offering more to the equity shareholders by adding the debenture holders percentage in our capital structure, company's benefit is nil. So this will be constant. Main thing that you have to understand is under NA approach, KO is changing. Under NY is KE is changing. Clear? Now see, how can you calculate the value? NY by KO. NY by KO. If the KO is constant, what about the V? If the KO is constant, means if NY is 100, KO is 10%, then the V is 1000. If the 10% remains same at all level, this 1000 also remains right, same constant. But if the KO is changing, probably earlier 10, suddenly it changed to only 20%. Then what happens here? It's only 500. If the KO is changing, value is also changing. So under the both the model NA and NY, where the KO is changing, KO is changing here. KO is changing here. As KO is changing under NA approach, value is also changing. Under this one, KO constant, so value is also constant. Why the value is constant? Right, KO is constant, because of that value is also constant. KO is constant, value is also constant. Now, this one is dependent. The changing is called dependent. Those items not changing is called independent. Like that's how you can understand. So under NA approach, what is changing? KO. KO changing leads to change in value. Under NY, what is dependent? Changing? KE. Because of changing the KE, value will not be changed. Clear? So let me summarize here. Under NI, NY approach and all, no. So in NA approach, net income approach, right, net income approach, KO is changing. As KO is changing, value is also changing. Okay. Under NOI approach, KE is changing. Only KE is changing. As KE only changing, value is also not changing. And assume that we have no tax and we have only debt and equity. Debt and equity in the capital structure. Clear? These are the predominant ideas you have to keep in your mind. This one is very, very important to make the solution solved easily. Clear? Let me now proceed with the first illustration. Shall I move on? See, the following data related to the company SSA Limited. Use net income approach, determine the total value and KO assuming no tax. Usually we don't have tax. Immediately draw the 9 lines. What are they? You have to calculate equity, debt, value. First set of 3. Next set of 3 being NOI minus interest, NI. Next set of 3. Next being 3 items. What are they? KE, KD, KO. What approach we need to follow? Net income approach. Under net income approach, what happens? KO changes automatically, value also change. That's a structure. Now feed the details available here in the 9-line format. Net operating income 10,000, 10% debt 40,000, debt being 40,000 and KD being 10%. Cost of equity 12.5 percentage. Okay, 12.5 percentage. Clear? Now you try to feed the rest. How can you feed the rest? You can calculate the interest. Interest is nothing but debt into KD. Debt is 40,000. KD is 10 percentage. Then interest should be 4,000. Net income should be 6,000. Now, how can you calculate the KO? KO can be calculated this way: NY divided by value into 100. I have NY. Okay, I have NY. KO is equal to NY by value. I have NY, but I don't know value. I don't know value. Then how can I calculate E? E can be calculated this way: NI by KE. Do I have these two details? So whatever the available details, you fit that first. Here I have been given KE as well as NI. NI being 6,000, KE being 12.5 percentage. 12.5 percentage. 48,000. As you know, the equity being 48,000, you can calculate the value also easily. By summation of these two will be the value 88,000. Now you can calculate the KO. KO being 10,000 divided by value 88,000. What's the final value? 11.36 percentage. Otherwise, you can use the other formula also. What? Weight of equity, cost of equity, weight of debt, cost of debt. Weight of equity being 48 for the overall value of 88. That's what about the weight of equity. 88,000 is the value. Out of that, equity being 48. So 48,000 divided by 88,000. Okay, that's the weightage. Into, I just remove the 3 zeros. KE being 12.5 percentage. Okay, plus weight of debt, out of 88, 40 will be the debt's weight. So 40 by 88 into cost of debt being 10 percentage. Hope you will be getting 11.36 percentage. Okay, you can either use this model or this model. You will get the same answer. You will get the same answer. That's why I told you finish off cost of capital chapter and then come here. It's an extended version slide. Clear. State the effect on the total value and KO in part A. What happens in case of NA approach? Value gets affected because KE remains constant, D also remains constant, KO gets affected. So in NA approach, KO and value will definitely change. If the debt is raised by 20,000 and use the proceeds to buy back equity shares. So in B option 1, this one is option A. In B option 1, I raised debt. Already we have 40,000 rupees debt. So I am further raising another 20,000 rupees. Means I am increasing debt component 60. As I am increasing the debt component, that increased value can be used for repaying the shares, buyback shares. So this becomes 28,000. Okay, I'll keep it pending. This one can be finished later on. I'm not sure with that. So I'll just keep it pending. NY being 10,000 rupees. Interest being for the 60,000, 10% rate of interest, 6,000 will be the interest. And now NI being 4,000 rupees. Now what about the KE? Under NI approach, KE remains constant. KD remains constant. What are the values are going to be changing? This value will be changing. Okay. This value will be changing. Ultimately, will have the impact over value also. These two will get affected. Now come on, calculate the KO here. How can you calculate the KO? I cannot calculate, so I can calculate the KE first of all. For the KE calculation, equity. Here 4,000. I use this formula. 4,000 divided by KE being 12.5 percentage. Hmm? 32,000. Now the company's value is 92,000. So see, company's value got changed. Now what about the KO? For the KO, you can use the formula here. Overall NY being 10,000. Now today company's value being 92,000 and cost of capital being 10.87%. Company management, financial advisors are planning to work lesser. Huh? So rather than working for 12.5% equity shareholders demand, they want to work only for 10.87%. Okay, that's what about the NA approach. We can fund ourselves with a cheaper source so that we'll be free, tension free. But NY came in the other way. No, no, no. If you are working lesser, and you will be very happy because of paying lesser for the debenture holders, but we are not happy because of including the debenture holders. Our risk is increasing, so our demand rate will be totally different. That's a logic here. Now here 10.87. That's all. Come on. What could be the next question? So here rising the debt. Next question will be reducing the debt. That's all. If you are reducing the debt, definitely what happens? You are funding out of the costliest source of fund. Definitely the company's image will go down. That's what about the intention of NA. If you are sourcing cheaper fund, then company's value increase. If you are sourcing costliest fund, the company's image will be going down. Always remember KD is lesser and KE will be higher. Will it be reversal? In practical, it's always reverse only. KD will be higher. That's why some company and some individual people also get debt strapped. Okay, and trapped. Okay. Now B2. If the debt is redeemed by 40,000 by issuing equity shares, so redeemed by 40,000. So what happens here? Entire 40,000 is redeemed. We don't have debt. Purely equity company. Purely equity company. Right. So 10,000 rupees. We don't have any interest payment here. So the NI being 10,000 rupees and KE being 12.5 percentage and KD being 10%. Only two items are going to be changing. What are they? Value as well as KO will be changing. Now what we can do now? We can calculate the equity. For this you can use this formula. Okay, as per this formula, 10,000 will be the earnings equity available to the equity shareholders are NA divided by cost of equity being 12.5%. So this value being 80,000 rupees. And total value of the company being equivalent to the equity share capital only as we don't have the debt. And what about the KO? As per the KO, 10,000 is the overall payment you are going to do for the equity shareholders. Their value is only 80,000. So this is 12.5%. Understand that if there is no debt, in this case, KE is equal to KO. Okay. Because we don't have the debt component at all. So whatever the amount we earn is meant for the equity shareholders. So both are same. KE is equal to KO. If you are adding the debt, then that firm is called levered firm. Debt-free company will be usually called as unlevered firm. Next chapter, we are going to study about the leverages. So the term is used here. Whenever we talk about levered firm, the company has debt component in it. Is that okay? Come on, we can try the next illustration similar way for NY approach. In NY approach, what is the constant value? Value as well as the KO will also be constant. KE is increasing. What you save is taken by the KE. So KE is changing. As KE is changing, KO as well as value remains unaffected. KO is changing means the value is getting affected because value is calculated based on the NY divided by KO. If the denominator KO is changing, then value will get affected. Clear? If it is clear, text me. So we'll move on to the next one. I may try to finish off up to traditional approach today, and rest of the things modeling in Miller approach, some theoretical views of this chapter by the next class. Okay. The next class that will be over, and I need one more session for the leverages. Okay. For the CMA, we have different topics, can be studied separately. Okay, fund flow analysis, cash flow analysis, and comparative common size financial statement trend analysis, financial scores Z, M, F scores. All these chapters are especially for the CMA inter. Okay, I need special class for that. Okay, only for the CMA inter two students. Okay, just mugging up the formula. I don't know why they keep those things here. Anyhow, you're not going to use it in your practical life. Okay, I too don't have that in my memory. I just drafted the formula by referring various books. If you refer same book, no, you don't get any idea. So in my doctorate study, I have used Z score. Okay, so this one Z score, M score, F score. No, I used Z score in my doctorate study. So based on the Z score, I decided whether which company is having the solvency position better, which company may face bankruptcy in due course. For that only Z score was used. In my doctorate study, already the factors are there. I just feed the data and get the answer. Okay. But anyhow, in your practical life also, you're not going to use the formula. It's a lengthy formula. I don't know why they ask. The last time also I saw the question paper containing a question from Z score and other thing. Okay. You have to mug up. Even mugging up of the pi value itself, here attention for us. 22/7. They have given so many numbers. Okay. Even they used it for a temporary reason. See, my intention is not test your memory, test your understanding. No, so that one is all about testing your memory. Right, right. We'll see that. Let's move on to the next one. Net operating income approach, NY approach. So in NY approach, KE is changing. The rest of the things are the same. What are they? First, to start with equity, debt. If you add up these two, then you'll get the value. Then NY minus interest, you will get NI. Then KE, KD, KO. In the very first, determine the total value and KE assuming no tax. Usually we don't have tax. So A scenario, expected net operating income 10,000, debt 40,000, an applicable rate of interest 10%, and amount of interest being 40,000 into 10%, 4,000. That's all. And cost of capital being, KO is given 12.5%, because here KE is changing, so that should be calculated. Earlier illustration, no. What is changing? KO is changing, so we have to calculate the KO. KE is given. Under this case, K is changing, that is going to be calculated. KO remains constant. Clear? So this one remains constant. Changing, sorry. K is changing. As K is changing, rest of the things are constant. Right, sorry. Now, come on. 10,000 minus 4,000? 6,000. What about the equity? NI divided by KE. So we don't have NI. We have the NI, but we don't have KE. We don't have KE. If we don't have KE, we cannot calculate the E. Then what we can do? We can calculate the V. Value can be calculated how? NY divided by KO is the formula for value. So in the very first instant, NY being 10,000 and KO being 12.5%. Okay, 80,000 rupees. That is 40. Then you are aware about that the balancing figure should be equity. Okay, so you can use the reverse calculation here. These two to be calculated here. 40. Then you can calculate the KE, NI divided by KE. Sorry, NI divided by equity. Sorry, NI divided by equity in percentage. Come on, 15%. What happens in the second scenario? B. State the effect on the total value and KE in part A if the debt is raised by 20,000 and use the proceeds to buy back equity shares. So B scenario 1. So you raised debt by 20, so 40 becomes 60 and 40,000, 10,000 rupees. So this will be KD 10%, KO 12.5%. Interest is 6,000. 60,000 debt means at the rate of 10%, 6,000 will be the interest and NI being 4,000 rupees. Now you have to find out the V first of all. You have to find out the V first of all. So V being constant here, you no need to worry about that. Under this model, the V is always constant and K is also constant. So once you know this value, you can directly feed here. Only this one is not constant. K is not constant. Now equity plus debt is equal to value. Value is given, debt is also calculated, and the difference between these two is the equity. Now you can calculate the KE. KE is nothing but net income by equity. What's the value? 20%. Next, if debt is redeemed by 40% by issuing the equity shares, debt is redeemed by 40%. B2. Debt is redeemed. Then the debt becomes 0. Value remains same. And NY 10,000. We don't have any interest commitment. NI being 10,000. KE being changing. So this is not same. This will be 10%. This is 12.5%. And you can calculate this one as well as this one. As you know the value, you can calculate the equity easily, which is 80. And this can be calculated as NI being 10,000 divided by 80,000, 12.5%. Remember that in case of unlevered firm, KE is equal to KO. Only by mixing the KO debt, there will be change. But if there is no debt, then KE is equal to KO only always. Okay. Now, under traditional approach, it's totally different. All are changing. I will give the comparison as well as a small graph of these three. In the next class, we'll try to finish the third question also now. Okay, come on. Traditional approach. All are changing. All are changing. Change happens to all. The following data relate to company SSA Limited and the details are there and determine the total value in KO. The usual one. What are they? Equity, debt, adding these two, you'll get value NY minus I, NI, then KE, KD, KO. NOI being 10,000, debt 40,000, interest 10% and amount of interest 4,000, NI is 6,000, KE 12.5%. Then you can calculate what? NI and K is there now. Then you can calculate E. E is equal to NI by KE. NI is 6,000 divided by KE being 12.5%. 48,000. Then equity is 48,000 and value being 88,000. Now you can calculate the KO also. KO is equal to NY divided by B, NY in this case being 10,000, value being 88,000, 11.36 percentage. Okay. State the effect on total value on KO in part A if the debt raised by 20 and use the proceeds to buy back shares. Then, so what happens in case B1? So, your debt is raised by 20 and NY is 10,000. Now, K is 13.5 percentage. KD is also changing. Everything will be changing. Why? So, we'll discuss all these things in the next class with a comparison. Now, just apply the numbers given here. Now, 60,000 into 11% is 6,600. Am I right? Interest. And net income being 3,400. Net income being 3,400. Okay. Now, come on. Equity being NI by 13.5 percentage. 25, 185. Then value should be 85, 185. Then find out the KO. For the calculation of KO, NY by value in this case being 85,185. 11.74 percentage. Debt is redeemed by 40,000 is the next options. B2. Completely debt is redeemed. Right. So 10,000. And what about the KE here? 11.5 percentage. So we don't have interest. So we have only net income for the equity shareholders. Now what about the KD? KD is dash. You know that in case of unlevered firm, KE is equal to KO. So this will be 11.5 percentage. Is that okay? Now we can find out the equity. 10,000 is for the equity shareholders and the equity cost being 11.5 percentage. What is the ultimate value? 86? 956. The total will also be the same. Clear? Now, as per the traditional approach, which model you have to choose? The model gives you more value to the firm and lower cost. That should be chosen. Or value increase. Already we have studied, right? What is the intention of a capital structure decision? Minimum cost, maximum value. Okay. Both are interlinked. If the cost KO is decreasing, value will be increasing. The denominator value is the KO, no. If the KO is decreasing, the value will be increasing. So boosting the value is the ultimate goal. So under traditional approach, lots of combinations will be worked out and to find out which value will be highest one. That combination capital structure is finalized. Is that clear? Come on, make a note of it.